This is the first of the video series from Intermediate Accounting 1 dealing with Chapter 1, which covers the GAAP conceptual framework. This is going to follow along with your class notes, and hopefully you can go through and both see and hear what I have to add to the textbook's presentation of that. It's not a substitute for the textbook. You still need to see your investment in reading the textbook and in studying as part of your investment in your career. You just can't possibly get everything from hearing someone else. So let me encourage you to do that, to be diligent and use this as possibly a reinforcement of that or to give you an overview of it, but not something that replaces serious study of your textbook. You know, in class yesterday, I introduced the notion of the GAAP conceptual framework, and we talked about the development of GAAP, the history of that, the major players, the major events that brought about what we call generally accepted accounting principles. And I want to continue this discussion now by starting with this slide. Sometimes the GAAP is referred to as accounting's constitution. Sometimes it's called the Bible for accountants. It lays out the whys, the whats, the hows, the whens sometimes of how to properly account for transactions, events in the life of a business. So really what we're talking about here is about accounting theory, and here's a definition of theory: a system of assumptions, principles, rules, and procedures used to explain, analyze, and predict some phenomenon applicable in a relatively wide variety of circumstances. There are a number of theories out there, a theory of thermodynamics, for example. But here we're talking about the theory that underlies really the accounting profession as demonstrated, or at least as articulated in generally accepted accounting principles. This is a graphic that I borrowed from Southern Methodist University, found online. You'll see this representation in a number of places, but I think it's very helpful in putting things into perspective. These different layers, sometimes they're referred to as different levels of GAAP. So I may refer to that, and maybe you'll see that in your notes as well. First of all, we start with what the overall objective of accounting is, and the objective of financial reporting in particular. Financial reporting should provide information that's useful to present and potential suppliers of capital. They are our number one focus here. Equity investors, lenders, and other creditors, both present and prospective ones, in making decisions about providing resources to the company. Those people, those suppliers of capital, are making decisions on an ongoing basis about whether to invest in or lend in the company. And so they, very important in the life and the growth potential of a business, are outside the firm. And so they need to have some sense of, let's say, a foundation for understanding, or there needs to be a foundation of understanding, providing them with the information needed so that they can make the very best decisions, hopefully be rewarded when they make good decisions. Being punished is a reality when you make bad decisions about investing in the business. But this information may also be useful to a broad range of groups. You know, we refer to the financial statements as generalized financial statements. And so, as is oftentimes the case in life, when you try to do something for everybody, you may not do what any particular group would have you do. It's kind of like the sofa bed, as they say. It's not a very good sofa, and it's not a very good bed. But it's a combination of those. And so the generalized financial statements really try to reach out to a number, let's say to provide info to a number of users. But let's not forget that ultimately there is a priority that is focused on the external users of the users of information, suppliers of capital in particular, and when it comes down to between those, equity holders or creditors, equity holders win out in terms of their standing in a primary position of importance for us. The second level of the GAAP conceptual framework concerns what are called fundamental concepts, and these are the basic building blocks of accounting theory that do two things. First of all, explain the decision usefulness of accounting information. That is, what it is that makes a particular piece of information or a particular attribute of that information useful, and that defines the form and the content of the financial statements. We first deal with what are called qualitative characteristics of accounting information. And these break down into two basic subcategories: fundamental qualitative characteristics and enhancing qualitative characteristics. Very much like you might imagine, there's some that are absolutely essential And there's some that are really nice, that make it more understandable. And so that's what the distinction is between these here. The information a firm provides should be that which is most useful for decision making, but what are the common qualities of that information? That's what we're getting at here. The fundamental qualitative characteristics of accounting information, these critical attributes that make information relevant, that make it useful in decision making. First of all, deal with relevance. That is, that information has to be relevant. The information makes a difference in one's decisions about a business, and specifically about decisions to invest money in a business or to lend money in a business. Keep in mind that focus on the suppliers of capital. And under relevance, we actually have these three let's say, characteristics that are important. First of all, for information to be relevant, it has to have predictive value. You know, ultimately, we believe that, that investors use financial statements not to simply tell a story about what happened, although that can be useful, but more importantly, to give them some picture of what to expect in the future. And so this predictive value, the fact, let's say, the quality that I can use prior financial statements, income statements, balance sheets, statement of owner's equity, statement of cash flows, that I can use those from the past to sort of build a case for what's expected to happen in the future. That's what predictive value is all about. Confirmatory value looks backward instead and says that information also should be such that I can tell what happened. That is, that I can look at the financial statements and the income statement, and I can know what happened in the past in order to get to where we are today. You know, both of those are important. There used to be a joke going around that the auditors, those who, you know, more or less audit financial statements and provide assurance services, that the auditors are the troops who come in after the battle is lost to bayonet the wounded. That's a little bit graphic, I suppose, but we understand that the value of financial statements is not in what they tell you about what happened, although that can be useful and important. And confirmatory value is one of those, let's say, qualities of relevance or qualities of information that make it relevant. But predictive value is, let's say, even more important because we believe financial statement users are really not trying to learn a history lesson. They're trying to make judgments about the future. Thirdly is materiality. You know, there's always there's this persistent notion about accountants that they're always interested in counting the beans, as they say. You know, the little things that an accountant won't rest at night unless they exactly square with, you know, penny for penny in the accounts. And that's just not true. Accountants of any stripe are going to recognize that they're always in costs and benefits. Sometimes it's better to cut your line and to move on. But that's not to say that, you know, accountants aren't going to be, you know, focused on doing a good job and trying to get down to the bottom of the problem. Materiality is a difficult thing because the financial statements, for the most part, well, let's just say there are a number of places we'll see as we pursue this course where materiality becomes important in determining how we treat an asset, how we record it, to what lengths we go in order to, let's say, pursue a transaction, to figure out exactly how something is to be accounted for. And materiality is not an easy thing. Materiality to a company like Walmart might be in the millions of dollars. Materiality for a local privately owned, say, restaurant or coffee shop might be in the hundreds of dollars. And so there aren't any hard and fast rules about what materiality represents, and you would find as you work as an auditor that when you go out on a particular job, that company will have certain standards of, firm would have certain standards of materiality to observe as it pursues and conducts that audit. But those are the three qualities, or let's say characteristics of relevance, or that make information relevant: predictive value, confirmatory value, and materiality. The other quality of, major quality of, qualitative characteristic is going to be faithful representation. There's agreement, which means that there's agreement between a measure and the item or event phenomenon it's supposed to represent. I think in class the other day I said that we measure dollars in the financial statements, that we measure values for inventory, for instance, in dollars. not in pounds. I think you would say there's not much sense in showing in a list of values of cash and receivables and other assets, some dollar amount thrown in there. The value that we look at has meaning. It's and faithful representation here is one of those qualitative characteristics, and there are three components of it. First of all, completeness. That is, that the information required for faithful representation is provided. Sometimes in court, or in a court setting, we might hear someone swear to tell the truth, the whole truth, and nothing but the truth. So maybe there's some measure of that here. Does that value that we're looking at, does the way that we handle this, does it tell the complete story of this asset's value, where it came from, what its life is, and that sort of thing? Number two is neutrality. The info is not biased in favor of a particular user or a particular user group. Sometimes accountants will apply the modifying convention called conservatism when recording or presenting a particular item, and therefore deviate from strict application of this neutrality rule. One example of that would be, for instance, when at the end of a given period, let's say you're looking at the company's inventory. Typically, inventory is valued at whatever the company paid for it, historical cost. But in fact, there is a convention that's really has to be applied according to GAAP. It's called applying the lower of cost or net realizable value. Imagine you've got some inventory, you paid $10,000 for it, but let's say it's women's fashions and it's out of style. Or let's say that somehow it got damaged, and so it's not worth what you paid for it. In that case, if it is worth less than what you paid for it, historical cost, you would actually write it down to a lower value and record a loss and end up with a reduced value recorded for that inventory. But let's say the opposite circumstance had happened, that somehow this inventory that you has paid $10,000 for has now, because of popularity or changing market conditions, far more valuable now than it was when you paid for it. We don't write up asset values like that. We will record losses. Conservatism will require us to record losses in situations where, were the situation reversed, we would not record a gain. And so neutrality, let's say, has its is the general measure, a way to apply faithful representation here, but there are exceptions to that. And then thirdly, it's free from error. That's probably pretty straightforward there. We want it to be correct. And yet we realize that sometimes correctness is not possible. And so we deal with estimates. We'll see a number of times where we have to accept estimates. Estimated useful life, for instance, of physical assets like buildings and equipment. Estimated salvage value. Sometimes the selection of an arbitrary, the arbitrary selection of a method for depreciating assets. There are times where we have to deal with estimates, and accountants deal with those and accept those. They just have to be reasonable and, for the most part, broadly accepted for them to be useful.